Well, today it's like KKR, Blackstone, Carlisle, Apollo. Those would be the names that most people would hear about, in the news. But thousands upon thousands of funds, and firms out there, and a lot of really small ones that people would not have heard of. That you could have less than $100 million in a fund and be a private equity firm, and generally, they wouldn't have a $5 million minimum investment. They may have a $1 million minimum investment.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Hey, we've got a guest, one of my favorites. Haven't talked to him in a while. He's the author of The Private Equity Playbook, which is the best seller on this topic. A new version is coming up, and his name is Adam Coffey. Adam, great to have you back on. So before we get started, you got to refresh our recollection. What is private equity?
Well, Kerry, it's good to see you. It's good to be back. Hello to all your listeners out there. In lay terms, what's private equity? Everybody on the planet seems to understand and grasp the concept of a mutual fund. We can go on our Schwab account, we can pick a fund, we can invest our money, and then we have instant liquidity. These are public funds. We can sell them today, later on, this afternoon, tomorrow, next week, 10 years, always total liquidity. A fund manager pools all of the money from the individual investors and then picks a basket of stocks with which to buy and invest. Sometimes we pay fees, or loads to those fund managers, and that's how they make their money, and we're looking for the return. So private equity is similar, in construct and concept. Most private equity firms, they have a fund, and the fund lasts for about 10 years. So it's a 10-year fund life. They can invest money for the first 5 to 6 years. They typically, when they buy a company, a private company, they typically own that company for about 5 years. And so they're seeking to improve it, grow it, do the things that they do. And then eventually they have to sell it, because within that 10-year window, they have to return all of the capital, the proceeds back to the investors. The difference is that minimum investment size of a private equity fund is about $5 million. And you have to be an accredited investor with a ton of money because it's illiquid. This is a private fund buying private companies. You have no liquidity for, it could be as long as 10 years. So you have to be willing to invest large sums of money and essentially write it off for a very long period of time until it comes back to you at the tail end of the fund's life. And so no liquidity, large minimum investments, pool money from a bunch of investors, and then pick a basket of companies to invest in. Usually, they all invest 6 to 8% of their fund in any one company, and not more than 12, which means a typical PE firm could own between 8 and 16 companies in one fund. Big funds, buy big companies. Small funds buy small companies. A big fund like a KKR or a Blackstone with a $30 billion fund, they couldn't possibly buy small companies. They only have 5 years to invest the capital. It would take them 100 years if they were buying small companies. So big funds buy big companies, little funds buy little companies, and 33 million small businesses in the United States, only 3,000 on the planet that have $1 billion in revenue. And so as you get bigger, you get rare very quick. Multiples being paid for companies are much higher as a company gets bigger. Because those, large funds have fewer opportunities to put money to work. There's more competition, and they have to pay more to get the companies. So that's kind of the ecosystem. When I wrote the first edition of the Private Equity Playbook in 2018, there was $2.83 trillion in assets under management at the time. Now there's over $6 trillion. So private equity, even though we thought it was bloated back then, it's more than doubled in size just in the last 5 years.
Okay, so who are the biggest players in the field?
Well, today it's like KKR, Blackstone, Carlisle, Apollo. Those would be the names that most people would hear about, in the news. But thousands upon thousands of funds, and firms out there, and a lot of really small ones that people would not have heard of. That you could have less than $100 million in a fund and be a private equity firm, and generally they wouldn't have a $5 million minimum investment. They may have a $1 million minimum investment, but just like the amount of companies, how you got a ton at the bottom of the pyramid and you've got only 3,000 on the planet with $1 billion at the top, you've got a bunch of PE firms, and there's a whole lot more smaller ones than there are really giant big ones.
Okay. So, hey, these little, where do you think the opportunity is? Because like you're saying, there's only so many billion-dollar companies out there. Maybe you aim lower and you can get higher returns?
I think so. I think the I'll call it the action in private equity right now is kind of going on in the lower middle market. So these are funds that would be sub $1 billion, sometimes $1 billion, $1.5 billion, so hundreds of millions up to a few billion, call it, in fund size. Lower middle market is where you really can take advantage of this thing called arbitrage. So let me give you an example. I'm working on 3 buy and builds right now in the accounting, bookkeeping, payroll services type space. And so there's 1.8 million small bookkeeping and accounting firms in the U.S. And so they trade for really low numbers. They generally have very high free cash flow and a very nice profitability profile. They have no capital expenditure, a lot of free cash flow. So if I buy a bunch of small ones and don't pay much for them, I can create something a little bit bigger, and that little bit bigger company now trades for a higher multiple. And so the difference in arbitrage, I might have been paying 3 times to buy the small one. So every dollar of earnings, I'm paying $3 to buy. I could be selling for $10, 5 years down the road, making a $7 profit by doing nothing other than putting a bunch of small good companies together, and helping integrate them and teaching them to scale and learn how to improve margins and what have you. And as a result of that, the lower middle market, I tend to see multiples of invested capital being higher. So, the big boys, if you're buying a company and you're paying a lot for it because there's not many of them, your return profile is very different than when you're buying these small ones. So in the lower middle market, it would be typical to be modeling 4x multiple of invested capital, 5x multiple of invested capital. So for every dollar I invest, I get $4 to $5 back. And higher up the food chain, they're underwriting 2.5 times, maybe 3. But really hard to do when you're buying something that costs you, hundreds of millions of dollars or $1 billion to buy, and to get that kind of return in a short period of time.
Hey, what are some of the biggest private equity flops that you know about?
The biggest private equity flops? Wow. I think there's been several, over the decades. I could think back to, like when Hostess, was going from private company or public company, private company, and PE bought it. You see it in a lot of retail. You see a lot of big retail companies that have been bought by private equity. I mean, without getting into specifics of which fund or which name company, I see a lot of action in retail that's I won't call it questionable, but these are typically longer shots. So you've seen a real change, like in just American consumer behavior. So a lot of these big anchor, retailers that used to be found in shopping malls, well, as malls are dying, a lot of those big brands are dying too, and private equity has stepped in trying to rejuvenate them. We talked off camera. It's like, there are some subsets of private equity that are called distressed asset funds. So they're looking for these companies that are like one step away from bankruptcy. And, once upon a time, they may have been very successful companies, but now they've fallen on hard times. And there's funds out there that look for deals like that, where potentially you have enough assets in the company to kind of recover your investment. So you're kind of buying it below book value of the assets, and you're swinging for the fences trying to bring them back. And if you can't, I sell off the assets and I make some money on the assets for my investors. So some people are out there looking for those distressed opportunities. These are companies that probably would have failed, somewhere along the way eventually. And private equity brought in some capital and tried to save them.
Yeah. Okay. So there's going to be winners and losers in every endeavor in life, in business, just the way it is. But if you're looking to invest in private equity funds, how do you do it? What's the best way to go about it?
Well, so first we have to pick our kind of our favorite flavor, let's say. I like the lower middle market, as I said, because I think the average returns are higher. And there's so many small companies in the U.S., and around the world in every country that the mechanics of what's going on in the lower middle market, I think, are just more favorable to good returns. And so I can do research about funds. One of the companies I ran was owned by a great company called the Audax Group. They're out of Boston. On any given day, they own 50 plus portfolio companies that are all lower middle market. They're kind of a firm that buys companies that have about $15 million in earnings, and they take them up to about 50, and then they sell them upstream to some, bigger PE funds. And so on a company like that, if I do some just basic Google research, tell me about private equity firms that invest in the lower middle market, I can get a list of names. I can now go to their websites. I can look at their investor, sections, and I can start thinking and reading and looking at the kinds of companies that they own. And, with some basic research, I can develop a profile. There are ratings out there. They're private. It's hard to get a hold of the data without subscribing to a service that can cost a lot of money. But if I'm a big family office and I'm considering, investing in private equity, like Morningstar for for mutual funds, I can find ratings on past performance and history of different PE firms and how their funds have done. And, as a result, I can try to use, call it past history as an indicator potentially. But, and then it's all of these firms really, they have half of the firm is focused on raising the next fund, and the other half is investing and operating the companies that they buy. And so there's always someone that I can talk to, and they frequently hold conferences and investor meetings where I can then come and hear them talk in person. Annual meetings are always fun where they have CEOs up talking about the companies that they're building. So, with some research, we can develop a list of names. We can, but it takes the good old fashioned shoe leather of, having to sit down and do some research, just like any other stock we invest in. We have to do, if we do research, we tend to have better picks.
Okay, I'll buy that. Hey, any particular trends, Adam, in private equity now that we should be aware of?
Well, so, in the last 4 or 5 years, we left, call it the period of low to no interest rates, which allowed private equity firms to pay really high multiples for companies and to comfortably lever, call it half of the purchase price because the debt was so cheap. And typically when a PE firm buys a company, they use a combination of debt and equity. Recently, though, interest rates have been ticking up, and although they're not record high, they are higher than they've been in decades. And so, I remember as a kid in the 80s, house, if you're buying a house, mortgages could be in the teens, but they are high. And so as interest rates ticked up, that created an environment where we couldn't lever as much debt when we were buying a company. And so I'll tell you, Kerry, a game of chicken was played last year for about the first 6 months of the year. We had sellers, founders, who had high expectations on value, and they're looking for a really high purchase price because that's the way the market's been for the last 5 years. And then we had buyers who were saying, I can't write, it's like if I can't lever as much debt because of high interest rates, my equity check has to be much, much larger to do the same kind of deal that sellers are expecting. And so let me just tell you that founders won the game of chicken. Because the one cardinal sin of private equity is if I have a fund, is I can't do anything. I have to invest the capital or I can't raise my next fund. And that's because investors, I'm an LP, a limited partner in several PE funds. And, it's like if I'm holding my money out on the side, waiting for you to call my capital, unlike a mutual fund, I don't send my investment in up front. The reason that happens that way is because then private equity would have to calculate the returns based on the day I sent the money in. And they're like, right.
And then that doesn't look good because time.
No.
Right.
Yep. So they delay calling the capital until they have a company to buy, and then they call the capital. So I, as an investor, I'm holding the money out, and I can't put it in the stock market. I need to be ready to send it in whenever it's called. They've got 5 years to do that. And so, if I can't put in the market where I could get an 8% average return over a 30-year period, I'm looking for 16 to 20%, which is what the better private equity firms are doing, is double the S&P 500. And if you don't put my money to work, I don't get the 16 to 20. I also don't get the 8%. I get whatever the prevailing money market or, rate is. And now I'm pissed. And so you come back and say, hey, Adam, I'm raising a new fund. And I say, you didn't invest my last capital. No way am I giving you more. So this game of chicken that got played last year could only last for a finite amount of time. And eventually the PE money had to start flowing again. And so the founders won. I'd say that valuations are kind of down a little bit in a lot of industries, but still very lofty valuations being paid. And what's happening now is private equity firms are writing bigger equity checks, or they're bringing in co-investors, some limited partners that they want to reward, and they're letting them also make co-investments. And so the money has to flow. So deal flow is back to kind of normal. And what'll happen ultimately, you think of wine, you think of vintage. This year was a good year. That year was not a good year. Well, all private equity funds are rated based on their vintage. And the vintage year of a PE fund is the year they make their first investment. So as long as all funds are being rated at the same set of economic conditions, it's okay if returns are moderated for this higher interest rate period, because 10 years from now, by the time all these funds are dead and gone, they'll have already raised 3 more funds, and this will be ancient history. So that's some of the trends I've seen, is a little bit higher equity checks, a little bit lower on valuations right now. And, hey, everyone's looking for interest rates to come down back half of this year. It could be as much as a point, which...
What's your feeling?
Yeah, I think yesterday we saw that 818,000 job gains were reversed, so that puts extra pressure on the Fed. So I'm expecting half a point in September, and I'm expecting could be another half a point before the end of the year. So, and they've been saying for over a year, the downward pressure, all pressure's been interest rates are going to come down. The question is with what speed, and at some point they'll normalize to a more normal level, and that's a few points down from where we're currently at, and people are looking for that to happen over the next 18 to 24 months, and so that should also aid private equity deal making getting done. A lot of people think private equity brings a ton of capital to the table, but what they actually do is once they buy the platform company using roughly 50% debt, 50% equity historically, they then put the checkbook away. So if they're doing a buy and build and buying 15, 20 companies, they're using all debt, on that part, or trying to use as much debt as possible on that part of the equation to build companies so that they can preserve their capital to buy more companies as platforms. And, I would say that most PE firms are not over-levering companies. You hear about that in the news, but in reality, if a typical American buys a house and they have a 50% down payment on that house, most Americans would say, I'm not over-levered. They would be applauding the fact that they've got 50% equity in their home. And so I'm always, when I'm looking at deals, I'm looking for at least 2 times the cash coming out of the company that I need to service the debt. So a 2-to-1 debt service coverage ratio is what I personally model when I'm involved in doing buy and builds, because if there is an economic downturn and a company's earnings go soft, I want to make sure that there's adequate cash flow within the business to continue to service the debt that's required. So ideally, you don't over-lever. You put the right amount of leverage on so that you have good debt coverage ratios.
Okay. So private equity, it beats working?
Well, it's like I'm still sitting in an office. I turned 60 this year, Kerry, and I said after my third company, I was like, I'm not going to do a fourth big one. I have 10 years left in my career, in my own estimation, and so I've decided I'm going to spend the next 10 years teaching as many entrepreneurs and business owners how to succeed, beat the odds, and use the same tools that private equity uses on a large scale and I'm going to teach them how to do it on a small scale. So I'm working on 18 buy-and builds in total right now with smaller entrepreneurs, smaller companies, learning how to use M&A as a tool, learning how to accelerate organic growth, improve margins. And so I'm teaching smaller businesses how to use, what the private equity world has taught us over the last, 30 years, or so, and use it to their advantage. So instead of making the shareholders, of these big funds and firms, billions, let's teach small guys how to make 100 million, or millions.
Hey,
and
I could live with that.
Yeah. And so that's going to be the next 10 years of my life, is working with small companies. So I'm working with 68 small companies, 18 doing buy and builds, and having a lot of fun. I'm working more hours now than when I was a CEO. And, so I guess.
But you don't feel like you're working, right?
I don't feel like I'm working. I'm having fun. So why not?
Yeah. All right. Hey, great having you on again. Just tell us how we find you on the web, how we connect with you, Twitter, social media, website, all that stuff.
Yep. I don't have a social media team. I'm on LinkedIn multiple times a day. I'd say best platform to reach out to me directly is LinkedIn, and you're going to hear from me. My books are available on Amazon or anywhere you find books, and all versions, Audible and ebooks and soft covers and hard covers. So whatever you like to read. I can tell you that based on all my sales, 73% of people out there in the world still like holding a book in their hands and flipping paper pages, at least my book. Yeah, that's kind of the demographic number. It's like 73%, and then the others are split between ebook and audiobook.
All right. Excellent. Hey, appreciate you coming on. As always, Adam, I want to definitely touch base with you sooner before your next update of book comes out. And just tell us again the name of the book.
The name of the book is The Private Equity Playbook, second edition. The first edition's up there on the wall. And, I decided after 5 years it was time to update. So much stuff has happened in the world. So I appreciate everybody out there for listening and for your support. So, Kerry, good to see you.
Hey, and I guess we find that book wherever fine books used to be sold.
That's it. Or Amazon, where current books are sold.
Okay. Hey, if you've got a question for Adam or myself, feel free to shoot me an email, kl@kerrylutz.com. And hey, you'll find a link to Adam's LinkedIn. That works, yeah. On the show notes to this interview on financialsurvivalnetwork.com. Adam, pleasure. We'll talk to you again soon.
Take care, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.